Most people think you need thousands of dollars to start investing in the stock market. That's the first lie keeping you broke. The second lie? That investing is only for finance experts who speak in numbers and acronyms. And the third? That you've already missed the boat. Here's the truth nobody talks about. Right now, in 2026, more regular people are building real wealth through the stock market than ever before. But most of them started with less than $100 and zero financial background. So why do 90% of beginners still lose money in their first year? Because they're following advice designed to keep them confused. In the next 10 minutes, I'm going to show you exactly how to start investing the right way. No jargon, no complexity, just the system that actually works. And I'll tell you the one mistake that costs new investors more money than market crashes ever will. Stay with me, because what I share in minute 7 will change how you think about risk forever. Let's get something straight right away. The stock market isn't a casino, but the way most beginners approach it turns it into one. They download an app. They throw money at whatever stock is trending on social media. Then they watch their account bleed red and decide investing isn't for them. This happens because nobody explains what the stock market actually is in plain English. Here's the simple version. The stock market is where pieces of companies get bought and sold. When you buy a stock, you own a tiny piece of that business. If the business does well and makes money, your piece becomes more valuable. If it struggles, your piece loses value. That's it. You're not playing a game. You're becoming a partial owner of real companies. And that shift in thinking changes everything. Now here's what makes 2026 different from any other time in history. The barriers that kept regular people out of investing have completely disappeared. 20 years ago, you needed thousands of dollars just to open an account. You had to call a broker on the phone, pay massive fees for every trade. It was designed for wealthy people. Today, you can start with $5. You can buy fractional shares, meaning you don't need $3,000 to own Amazon. You can own 0.001% of Amazon for $10. The tools are free. The information is free. The access is completely democratic. But here's the trap. Just because it's easy to start doesn't mean people are starting smart. Access without education is just expensive entertainment. So let's talk about how much money you actually need. Forget what you've heard. You don't need $10,000 or even $1,000. If you have $50 to $100 that you won't need for emergencies, you can start. But, and this is critical, that money needs to be money you can afford to not touch for at least 3 to 5 years. The stock market goes up and down every single day, sometimes every single hour. If you invest money you need next month for rent, you're setting yourself up for panic. You'll sell at the worst possible time just to get your cash back. The golden rule is this. Only invest money you won't need in the near future. Everything else goes into an emergency fund first. Most financial advisors say 3 to 6 months of expenses saved before you invest a single dollar. That's not sexy advice, but it's the foundation that keeps you from making desperate decisions later. Here's where most beginners go wrong right out of the gate. They pick individual stocks based on hype. Someone on TikTok says a company is about to explode. A friend made money on some tech stock. They see a headline about a new product launch. So they buy, and sometimes they get lucky. But luck isn't a strategy. Picking individual stocks means you're betting that you know more than millions of other investors, analysts, and algorithms. You're competing against people who do this professionally with teams and data you don't have. For 99% of beginners, this is a losing game. So what should you do instead? Index funds. This is the secret that boring millionaires don't talk about because it's not exciting. An index fund is a collection of hundreds or thousands of stocks bundled together. When you buy one share of an S&P 500 index fund, you own a piece of 500 of the biggest companies in America. Apple, Microsoft, Google, Tesla, all of them, in one purchase. Why does this matter? Because you're not betting on one company anymore. You're betting on the entire economy. And historically, over long periods, the economy goes up. The S&P 500 has averaged about 10% returns per year for the last 50 years. Some years it's up 30%. Some years it's down 20%. But zoom out, and the trend is clear. Up and to the right. Let me give you a real example. Imagine you invested $100 every month into an S&P 500 index fund starting in 2016. 10 years later, in 2026, you'd have put in $12,000 total. but your account would be worth over $20,000. You didn't pick stocks. You didn't time the market. You just showed up consistently. That's the power of index investing. It removes emotion. It removes guesswork. It automates wealth building. And the best part? The fees are almost nothing. While actively managed funds charge you 1 to 2% per year, index funds charge 0.03%. That difference might sound small, but over decades, it's tens of thousands of dollars staying in your pocket instead of going to fund managers. Now, let's address the question everyone asks. When should I start? Is now a good time, or should I wait for a crash? Here's the honest answer. Nobody knows what the market will do tomorrow. Not me. Not Warren Buffett. Not the experts on TV. Trying to time the market is like trying to predict the weather 6 months from now. You might get lucky once, but you'll be wrong way more often. The data is clear on this. Studies show that timing the market beats timing the market almost every single time. That means starting today, even if the market is high, is better than waiting for the perfect moment that may never come. Because while you wait, you miss out on gains. You miss out on dividends. You miss out on the compounding that happens when your money makes money. There's a saying in investing. The best time to plant a tree was 20 years ago. The second best time is today. That applies here. Start small if you need to, but start. Here's the step-by-step process to actually begin. First, choose a brokerage platform. In 2026, the best beginner-friendly options are apps like Fidelity, Charles Schwab, or Vanguard. They're free to use. No account minimums. No trading fees. Avoid the platforms that gamify investing with confetti and notifications. You want boring and reliable, not exciting and distracting. Second, open an account. This takes maybe 10 minutes. You'll need your social security number, bank account info, and basic personal details. Third, decide between a taxable brokerage account or a retirement account. If you're investing for retirement, open a Roth IRA. You put in after-tax money, but it grows tax-free forever. If you want flexibility to take money out whenever, a regular brokerage account works. Fourth, deposit money. Link your bank account and transfer however much you want to start with. Fifth, buy your first index fund. Search for something like VTI, which is Vanguard's total stock market fund, or SPY, which tracks the S&P 500. Purchase shares. Done. You're now an investor. But here's what nobody tells you about what happens next. The market will drop. Maybe next week. Maybe next month. Your account will show red numbers. You'll feel panic. This is the moment that separates people who build wealth from people who quit. When the market drops 10 or 20%, your brain screams at you to sell. It feels like you're losing money. But here's the reframe. You only lose money if you sell. If you hold, those losses are temporary. In fact, market drops are when you should be most excited because stocks are on sale. Think about it this way. If your favorite store had a 50% off sale, would you run away screaming or would you buy more? The stock market works the same way. When prices drop, you're getting more shares for the same amount of money. This is how wealth is actually built. Not by avoiding losses, but by staying calm during them. Let me tell you the one mistake that costs beginners more than anything else. It's not picking the wrong stock. It's not starting with too little money. It's stopping. Most people invest for 6 months, see their account fluctuate, get scared or bored, and quit. They pull their money out and never come back. Meanwhile, the people who get rich from the stock market are the ones who stay invested through the boring years, the scary years, and the exciting years. Consistency is the entire game. If you invest $100 a month for 40 years, even with average returns, you'll end up with over $500,000. But if you stop after 5 years, you'll have maybe 8,000. The difference isn't skill, it's endurance. Here's another psychological trap to avoid. Comparing yourself to others. You'll see people online bragging about turning $1,000 into $50,000 in 6 months. Those stories are either lies, survivorship bias, or extremely risky gambling that isn't repeatable. For every person who wins big on a single stock, there are hundreds who lost everything trying the same thing. Your goal isn't to beat the market. It's to match it. 10% per year might sound boring compared to some crypto bros' 300% gains. But 10% per year, compounded over decades, builds generational wealth. Flashy wins make good stories. Boring consistency makes millionaires. Let's talk about diversification because this word gets thrown around but rarely explained. Diversification means spreading your money across different investments so that if one fails, you don't lose everything. If you put all your money into one stock and that company goes bankrupt, you're wiped out. But if you own 500 stocks through an index fund and one company fails, you barely notice. This is why index funds are so powerful for beginners. Instant diversification. You're protected from individual company risk. The only risk you're taking is market risk, which historically always recovers given enough time. Now I want to address something controversial. Should you invest if you have debt? The answer depends on the interest rate. If you have credit card debt at 20% interest, pay that off first. There's no investment that reliably beats 20% returns, so you're losing money by investing instead of paying off that debt. But if you have student loans at 4% or a mortgage at 3%, you can invest while paying those off. Because historically, the stock market returns more than 4%. You're mathematically better off doing both. This isn't emotional advice. It's math. Here's a framework to think about your money. Imagine 3 buckets. Bucket 1 is your emergency fund. 3 to 6 months of expenses in a high-yield savings account. This is your safety net. Bucket 2 is short-term goals. Money you'll need in the next 1 to 3 years. Maybe a car, a wedding, a down payment. Keep this in safer places like bonds or savings accounts because you can't risk a market drop right before you need it. Bucket 3 is long-term investing. Money you won't touch for 5, 10, 20, or 40 years. This is where stocks and index funds live. This is where you take on risk because you have time to recover from downturns. Most beginners mix these buckets. They invest rent money or vacation money and panic when they need it back. Separating these buckets removes that panic. One more thing about taxes, because this confuses everyone. When you sell a stock for more than you paid, you owe taxes on the profit. If you held it for less than a year, it's taxed as ordinary income, which can be high. If you held it for more than a year, it's taxed at the lower capital gains rate. This is why buy and hold strategies are not only less stressful, but also more tax efficient. You're not constantly triggering tax bills. And if you're investing in a Roth IRA, you don't pay taxes on gains at all when you retire. That's free money the government is letting you keep. Take advantage of it. Let me give you a mental model that changed everything for me. Investing isn't about getting rich quick. It's about getting rich for sure. Slowly, predictably, boringly. The stock market isn't a lottery ticket. It's a wealth transfer system from the impatient to the patient. Every time someone panic sells during a downturn, someone else is calmly buying at a discount. Every time someone chases a hot stock and loses, someone else is steadily building wealth in index funds. The market rewards discipline, punishes emotion, and doesn't care about your feelings. Once you accept that, you stop making emotional decisions. You automate your investments. You ignore the noise. You check your account maybe once a quarter instead of once a day, and you let time do the heavy lifting. Here's what I want you to do today, not tomorrow. Today, open a brokerage account. It takes 10 minutes. Even if you don't deposit money yet, just having the account removes the psychological barrier. Then set a date on your calendar. 1 week from now, on that date, deposit $50 or $100. Doesn't matter how small. Just start. Then buy 1 share of an index fund. That's it. You're now ahead of 90% of people who talk about investing but never actually do it. And here's the secret. Starting is the hardest part. Once you're in, once you see your account grow even a little, the momentum builds. You'll want to add more. You'll start learning more. You'll become the person who talks about investing at dinner parties. But none of that happens until you take the first step. The stock market in 2026 isn't some exclusive club. It's not rigged against you. It's not too late. It's a tool. And like any tool, it works if you use it correctly. You don't need to be smart. You don't need to be rich. You just need to be consistent, patient, and willing to ignore the noise. The people getting wealthy right now aren't the ones making headlines. They're the ones quietly investing every month, reinvesting dividends, and refusing to panic when everyone else does. That can be you, starting today, with whatever you have. The question isn't whether you can afford to invest. It's whether you can afford not to.